Have you ever wondered if you're doing better or worse than most people when it comes to money? Maybe you've been lying awake at night thinking about your bank balance, asking yourself if people your age have more saved than you do. Or maybe you're scrolling through social media, seeing friends posting about their latest vacation or brand new car, and you can't help but wonder how they're paying for it all. Well, today, I'm going to pull back the curtain on what the average person's financial situation really looks like. And I promise, some of these numbers will shock you. Some might make you feel a little better about where you stand, while others could be a serious wake-up call. Either way, by the end of this video, you'll have a clear picture of how your finances stack up compared to everyone else. If you are looking to get your finances on track, and maybe even get ahead of the crowd, be sure to hit that subscribe button and give this video a like if it helps you out. Before we get into the eye-opening stats, let me ask you this. When you picture the average person's financial life, what comes to mind? Do you see someone who's got it together, steadily building wealth and preparing for retirement? Or do you imagine someone living paycheck to paycheck, hoping everything works out somehow? The truth is, most of us really don't know what normal looks like when it comes to money. We base our assumptions on what we see around us, but the reality is often very different. And that's what makes this topic so interesting. Understanding the numbers isn't titinine, mind titwinens, just about curiosity. It's about equipping yourself to make smarter decisions with your own money. Think about it this way. If you're trying to get in shape, wouldn't you want to know what the average person weighs or how often they exercise? If you're trying to raise your GPA, wouldn't you want to know where you stand compared to other students? Money works the same way. Once you understand how you measure up, you can make better choices about spending, saving, and investing. So let's start with something that affects every working person in America. Income. When you cash your paycheck every couple of weeks, are you making more or less than the average worker? According to the latest Bureau of Labor Statistics data, the median weekly earnings for full-time workers are just over $1,000. That adds up to roughly $52,000 a year before taxes. Now let's break that down. We're talking about individual income here, not household income, which might include a spouse or other family members working. And remember, median means half of workers earn more than that, and half earn less. It's the middle of the pack. If you're pulling in around $26 an hour, you're right there with the average full-time worker. But here's the catch. That $52,000 is before Uncle Sam takes his share. After federal and state taxes, plus Social Security and Medicare, that figure shrinks fast. Income, though. According to the Federal Reserve's most recent survey, the median amount Americans have saved for retirement is $65,000. But keep in mind, that includes everyone of all ages who even have a retirement account. And here's the kicker. About 25% of Americans don't have any retirement savings at all. Zero. That means 1 in 4 people is planning to rely entirely on Social Security, assuming it's still around when they retire. For those who do have something saved, the numbers vary a lot by age, and some of them are pretty alarming. People under 25 have a median balance of less than $2,000. To be fair, if you're 23 and just starting out, having $2,000 isn't bad, but it shows how important it is to start early. The 25-34 age group has a median balance of around $14,000, still pretty low, considering many in this group have been working for years. By the time we get to folks 65 and older, the median climbs to about $88,000. That might sound decent until you put it in perspective. With $88,000 saved, using the 4% withdrawal rule, you'd only be able to take out about $3,500 per year. That's less than $300 a month. Think about that. Could you survive on $300 a month in retirement? Even if your house is paid off, $300 won't cover groceries, utilities, healthcare, and everything else you need. And this is why these numbers matter so much. If you're in your 20s, 30s, or 40s, and you see how low the averages are, you need to seriously ask yourself whether you're saving enough, because most people aren't. Speaking of Social Security, since so many people expect to depend on it, let's see what the average benefit actually provides. Now, let's shift gears and talk about day-to-day spending. According to the Bureau of Labor Statistics, the average American household spends about $5,577 a month, or about $67,000 a year. That means the typical household needs at least $67,000 in take-home pay just to break even. If you want to save or invest, you've got to earn more than that. The biggest expense is housing. No surprise there. Households spend about $1,885 a month on housing. That's over $22,000 a year just to keep a roof overhead. And if you live in a big city like New York or San Francisco, that number probably feels like a joke. It wouldn't even get you a decent one-bedroom. Next up is food, at about $691 per month, or more than $8,000 per year. If you're feeding your family on less than $700 a month, either you've mastered budgeting or you're eating a lot of ramen noodles. Transportation is another $913 per month, nearly $11,000 a year, covering car payments, insurance, gas, maintenance, or public transit. Add housing and transportation together, and you're already over $2,700 a month before considering anything else. And then there's credit. Most people know their credit score matters, but they don't always know how they stack up. According to Experian, the average FICO score in the US is 715, considered good. That means a lot of people are at least doing a few things right, paying bills on time, keeping balances reasonable. But don't let that number fool you. Plenty of people are walking around with scores in the 500s and 600s, struggling to get approved for loans or decent rates. Your credit score impacts everything from your mortgage rate to your car loan, and even some employers check it. The good news is, it's not rocket science. Pay your bills on time, don't max out cards, and don't open new accounts every time a cashier offers you 10% off. Simple, but a lot of folks still trip over it. Now for the ugly part, credit card debt. The average household carries over $9,000 in credit card balances. And we're not talking about mortgages or car loans. This is money spent on stuff that often loses value fast. Add interest rates of 15 to 25%, and that $9,000 could cost you nearly $2,000 a year in interest alone. That's money wasted, money that could have gone toward building wealth. Most of that debt comes from lifestyle spending, clothes, electronics, dining out, online shopping splurges. Emergencies do happen, but let's be honest, a lot of it wasn't emergencies. The fix? Pay off balances in full every month. If you can't afford it in cash, don't charge it unless it's truly an emergency. And if you already have a balance, paying it off should be your #1 priority, even ahead of investing. No point earning 7% in the market if you're paying 20% on debt. Next, let's look at net worth. This is probably the best single measure of your overall financial health. Net worth is simply what you own minus what you owe. These numbers are actually achievable for most people with steady incomes and basic discipline. You don't need to invent the next big app or hit the lottery. Spend less than you earn, invest the rest, and you'll hit these milestones. But here's the problem. Americans are only saving about 6% of their income after taxes. 6%. That's not much once you factor in short-term goals like buying a car or saving for a down payment. Experts generally recommend at least 10 to 15% just for retirement, and more if you want to retire early. Speaking of retirement, the average age Americans actually retire is 61. Sounds good, until you realize full Social Security benefits don't kick in until 67. That's 6 years you'll need to cover on your own. And if your retirement savings look like the averages we discussed, that could be a rough stretch. Add to that the fact that someone reaching 65 today can expect to live 20 more years or more. That means funding retirement for possibly 25 years, longer than many people's entire working careers. The big question is, how many of those years will you be healthy enough to enjoy? Here's the bottom line: the average American's financial plan just isn't cutting it. Less than $90,000 saved for retirement, $9,000 in credit card debt, and only 6% of income going into savings? That's not a recipe for success. But here's the good news. Beating average isn't hard. If you save more than 6%, avoid credit card debt, and consistently invest, you're already ahead of the majority. Think about it this way. If the average household spends $5,500 a month, but you figure out how to live comfortably on $4,500, you've freed up $12,000 a year. Keep that up for decades, and you'll be in a whole different league. Small improvements across multiple areas, income, savings rate, debt, and investing, compound into a huge difference over time. What really stands out is the gap between what people say they want and what they actually do. Everyone says they want financial security, a comfortable retirement, and peace of mind. But their actions don't line up. Maybe they think everyone else is doing better than they are. Maybe they don't know where to start. Or maybe they think it's too late. But it's not. Once you know what average really looks like, you can do just a little bit better. And that little bit can change everything.